We are just waiting for people to come on to the Financial Promise 30 Minutes of Power with Jason Fields webinar. And so just want to make sure I get some people. Hey, everybody. Glad to see you guys joining me. Just want to make sure you all can hear me. For all of you who can hear me, just let me know. Jay Ham, I see you. Letitia Coulter, I see you. Thank you for joining. Avery Washington, thank you for joining. We're going to get started because we want to make sure that we forgive me for that, guys. Just want to make sure I get this right. Give me a second here. All right, I'm just trying to make sure I get this done the right way. So forgive me for that. I want to unmute you. There we go. So I am just waiting for everybody else to join, guys. We'll get started here. And then in a few more, maybe a couple more seconds or minutes, we'll get started. I may have lost somebody, but I want to thank you all for joining. And this shouldn't be long. I think many of you have took the class, have done some things with me. And so I want to make sure that you're allowed to ask questions as we set up this webinar and make sure that we're doing this thing the right way. So I believe you guys can, if you have questions, I believe you can just make sure you indicate that. Yep. So if you have questions, let me know. You should be able to hit me on a tab or something like that. Jayham, thanks for joining again. And so before we get started again, I just want to make sure I give some time for everybody to get on board. I know it's kind of late. In fact, I just came back from Madison and want to make sure that I had everything set up for you all. So we're going to give a few more seconds, maybe a minute or so, and then we'll get started. We'll get started with the how to invest like Warren Buffett. It's not complicated. Just want to make sure I show you all some things that when you look and start to invest in stocks, in particularly, there's a method to the madness. And so I am going to make sure that this is a rebroadcast, that we play this, that I put it on my YouTube channel so that many of you, if you forget, you can go back to it. There's also a book that I use, which was one of those easiest books that I looked at. And it brought me into why I wanted to do this segment, because I thought it was fascinating. I thought it was simple and easy to understand, and most people can follow it. So with that, gang, we're going to get started. And what I want to do first off is just give me a sec. Before we go there, here we go. Give me a second, guys. All right, I want to make sure I can see. I want to make sure you guys can see this. And here we go. So the name of the company is Financial Promise. You all know that if you've been following me on Facebook, LinkedIn, and Twitter. You can go to the Financial Promise, www.thefinancialpromise.com. And what I want you to do is continue to follow that, because consistently you'll see I'm doing the classes, you'll see the webinars, we've done these. And so that's one way for you to keep track of what we're doing, the classes, things of that nature. And you can see here, this is the last class. This will be coming up on February 17th, Budgeting Basics with Jason and Latasha Fields, where we'll take you through quite a bit of budgeting, planning, playing offense and defense with your money and investing. And more importantly, we will talk about, as a newly married couple, people who've been financially trying to do things on their own and now coming together, some of the pitfalls and some of the strengths and weaknesses that we had that we overcome. And so go to www.thefinancialpromise, and you can see that as we talk about the upcoming classes, you'll be able to follow and enroll when you go to the Financial Promise. Now, first thing I want to cover is when you go to the Financial Promise, what we try to talk about is basically, it doesn't take a lot to start investing. We try to show and teach you to figure out what kind of investor you are. And everywhere I go, what we look to do is make sure that, let me just minimize this, that whenever we talk about investing, I try to make my website, my site, one-stop shop for you all. And so you can go to Ally Invest. Here you can invest in stocks, mutual funds, bonds, electronically traded funds, options. And I use all of these accounts. So I use Ally Invest, where the commission is $4.95 per trade. It's one of the cheapest in the industry. For foreign currency, which I'll be doing some seminars and webinars on that, you can go to forex.com. And for those of you who want to get started and you have spare change, I like Acorns because basically it's set up where you don't even notice that the money is gone. And so you're investing spare change in $5 increments. And this way you don't have to worry about it. Every time you use your debit card, for example, I do a lot of Starbucks. Every time I buy coffee, at the end of the day, I'm investing. And so what we want to do is make sure when you go to Financial Promise, you can enroll or open up these accounts, and we'll be covering some of those at a later seminar. So now let's get started. So one of the things that I came across was, as we're talking about investing, I wanted to sort of get behind or learn from the best. And Warren Buffett, for those of you who don't know, is basically, give me a second, basically one of the best investors of all time. In fact, most people don't know Warren Buffett made most of his money after the age of 65. And so there were some rules and characteristics that Warren Buffett talked about, or as how he approached investing. Now, to show you where I got this from, let me just make sure I have the right site, because I want to show you, here's the book as to where we take this webinar today. And I bought this book on Amazon, and it's a simple read, it's easy to understand, and it gives you the basic characteristics and rules on how to invest like Warren Buffett. It's a very simple, easy to understand book. And as you can see, the author is Matthew Crater. I would advise any of you, it only costs around $6 to grab the book. Again, it's a simple read. Author, 48 pages, you guys will get done. It's a very easy read. It will take you maybe an hour, if that, not even. Description of the book for beginners who would like to finally learn how to pick stocks, learn how Warren Buffett does it. And so you can read this. And then even at this site, guys, at the end, you could download this book. For sake of argument, I would just go ahead and buy it at Amazon.com, because again, maybe it's 10, 12 books after you've shipped it to yourself. So what we're going to do here is, when we look at investing like Warren Buffett, there's a phrase that Warren Buffett typically, this is what he exercises. And so he says that investing is, there are only two kinds of companies to invest in: a great company or everything else. So he breaks it down and keeps it very simple. There are only two kinds of companies to invest in. There are great companies, and then there's everything else. And so what he does and what the book does and what we're going to walk you through is, how do you distinguish between the two? Remember, there's a great company and then there are everything else. And so the first thing are 5 characteristics that the book and that Warren Buffett and that value investors subscribe to that lets us know whether it's a great company or not. The first rule is, and I'm going to make sure I show you all of this stuff and you can see it. First rule is it must be simple. So you must understand the company. If I asked you, what does Nike do? You all would say, hey, we know what Nike does. We understand it. They make shoes, they make sports clothing, they're a product line, they deliver sports clothing. So we know what Nike does. If I asked you what Intel does, some of you may know, some of you may not. Not to say Intel is not a great company, but the myth or the thing is, for all of you starting, the first thing you should be able to do when you're investing is you need to invest in things you understand. The second characteristics of whether a company is great is it has to have great brand recognition. Has to have great brand recognition. If I made the Nike swoosh sign, you all would know that's Nike. If I grabbed a bottle of Coca-Cola, even if it didn't have the words Coca-Cola on it, you would know. If you go to any country on the planet and you saw the golden arches, you would know that's McDonald's. So it has to have great brand recognition. The third characteristic of a great company is it sells products or services that never go out of style. Nike, McDonald's, GE, all of these companies sell products or services that for the most part will never go out of style. The fourth characteristics, consumer will purchase the product again and again. So one of the examples I use is that if Nike's, and you all can verify this, those of you who buy Nike tennis shoes, Nike tennis shoes can go up to $300 and people would still purchase Nike tennis shoes. Coca-Cola could go up to $3 a can and people would still purchase Coca-Cola soda. The fourth rule, or the fifth characteristic, is that it has to have pricing power. It has to have pricing power when evaluating the business. If it's a great company, it has to have pricing power, meaning it will stay in competition, or it will have, even if they raised its prices, even if the company raised its prices, people would still buy it. People would still use the product. People would still, purchase the service, and they would still do this even when competitors entered the arena. So even if competitors entered this place, this organization, whether they're products or service, their pricing power would be strong enough to the point where they wouldn't get forced out of business. So these are the 5 characteristics of what a great company is. And so when we talk about great companies, and when we talk about companies and stocks we want to invest in, remember, there are great companies, there are everything else. The way we know whether it's a great company or not, the characteristics is, 1, a great business must be simple. 2, it has great brand recognition. 3, it sells products and services that never go out of style. 4, consumers will purchase the product or service again and again. And 5, it has pricing power when we evaluate the business. So those are the 5 characteristics of whether or not a company is great. Now, most of us will believe we know a company is great because, for the most part, it may have some of those. It may even meet all of those definitions or characteristics as to whether or not it's a great company. Now, the question as to whether you should invest in it or not That's a little bit different. And so now what we talk about when we look at, okay, if the company displays the characteristics of a great company, how do we know we should invest in it? How do we know that it's a good stock to purchase or it's a good stock to invest in if it shows us the 5 characteristics of a great company? Remember, it may display the 5 characteristics of a great company, but now we need proof to verify that it's a great company. So one way of doing that is we look at, give me a second, we look at the 5 rules as to whether or not a company is great. 5 rules to whether or not a company is great. And for this example, what I'm going to do is take you through how we determine these 5 rules, where we get the data, the information, how we determine whether or not the data matches up with the fact that even though the company may display the 5 characteristics, what do the numbers have to say? So let's take a look at Home Depot, Intel. Give me a second, guys. I'm going to make this bigger. ExxonMobil. Give me a second. And Coca-Cola. Home Depot, Intel, come on, ExxonMobil, Coca-Cola. So the first rule as to whether a company is great or not, the data. A great business will have, I just want to make sure I highlight this for you. A great business will have earnings that show a smooth upward trend. A great business will have earnings that show a smooth upward trend. Let me erase this. So what we're going to do now, give me a sec. Let's start with Home Depot. Remember, the first rule is, will it have a smooth upwards trend in earnings per share? Smooth upward trend in earnings per share. So we're going to go here on our value line, and we're going to find earnings per share. You see it here. And what we're looking for is a smooth earnings per share upward trend. 129, 156, 188, 2.26, 2.72, 2.79, 2.27, 2008 recession. So we see 1.78, 1.66, and so forth. So is there a smooth upward trend? Well, for the most part, yeah. For the most part, yeah. Gotta keep going back and forth. Now, secondly, a great business will show a consistent return on equity above 20%. A consistent return on equity above 20%. So what we're going to do, forgive me for that. We're going to find return on equity on this value line sheet, and I'm going to show you guys how to get to value line where you get this data. We're going to scroll all the way down to the bottom, and we're going to find return on shareholder equity. And the number we're looking for is above 20%, consistently above 20%. So we look at return on shareholder equity. And we see 23.8, 16, 14, 17.8, 21, 26, and so forth. Now, the question is that a smooth 20% consistently? And the answer to that is no, because we've had several years where it was below 20%. Now, this NMF basically means that, it wasn't even worth mentioning. So when you see this NMF, that should be sort of a red flag, because you want to go, okay, we see some of the earnings per share, but at this point in time, it wasn't worth mentioning for whatever reason. So the number we're looking for is 20% consistently. The third rule: a great business will show a consistent return on capital greater than 15%. Now remember, we were looking at return on equity above 20% here. The number we were looking for was 20%. And now we're looking for, come on, a consistent return on capital greater than 15%. Now, when we go back to, again, Home Depot, we saw that the return on equity, the number we were looking for was 20%. If you look right above that, you can see return on capital here. Let me just take this line off. So right above return on shareholder equity, you can see return on capital. And we're looking for consistent above 15%. We see 15.5, 11.9, 11.1, 13, 14, 18, and so forth. So again, even though in some of the later years it's above 15, we don't see a consistent above 15 number. So we're looking for a number of return on total capital 15% and up, 15% or above. And we don't see that consistently with Home Depot. Now, the fourth rule is it will invest in companies where the long-term debt, so I'll just do this. The long-term debt could be paid off within 4 years or less using net profits. I'm gonna repeat that. We're looking for companies that can pay off their long-term debt within 4 years using their net profits. So let's go to the chart and see if we can find that. Now, when we go to Home Depot, again, we're looking at Home Depot. We're looking for net profits, and we're looking for long-term debt. Can we pay off the long-term debt in 4 years with our net profit? As we can see, our net profit is $10.7 billion. This is in millions, so remember you got to add 6 zeros. Our long-term debt, $25 billion. Can we, in 4 years, with our net profit, pay off this $25 billion? Well, we're making $10 billion a year, so yeah, or close to 11, so that's $44 billion. Yeah, we can pay that off. Now, the last rule, come on. Give me a second, guys. Sorry about this, guys. A great business pays a dividend or buys back its stock. A great company will pay dividends, buy back stock. If we go back to the data, again, remember, we're looking at Home Depot. Let me erase some of this so you guys don't get come on. We're looking for dividends declared per share. And we're going to go here. And we see that, yeah, every year from 2001, they've been declaring dividends per share. So that usually means that the stockholders are getting that dividend. Typically, on average, it's in stock. In some cases, it may be paid out in cash. For example, We Energies pays their dividends out in cash. I forget what their dividend is, but you usually receive a check, I want to say maybe once a quarter. So I think their dividend, if you look at this, let's say 2017, 2018, $4.16. So you may receive $1 every 3 months, basically. So the question is Home Depot a great stock? Well, it's an okay stock. It's like everything else. It's okay. It doesn't mean that you shouldn't buy Home Depot. It may mean that there's a time and a place when you buy a stock like Home Depot, simply because when you look at the recession, logic would dictate that if people are not buying home materials, there's a recession. If home purchases are down, who would be shopping at Home Depot? Simply because we're in a recession, nobody has disposable income, so they're not doing things like that. When the economy is good, a stock like Home Depot may be great buy at that time. It's more of a cyclical stock, meaning it fluctuates with the economy. So if you ask me, is Home Depot a great stock? It's okay. It's like everything else. I wouldn't look at it as a great stock. Let's look at Intel, and then we'll look at another one, and then we'll round this out. So remember, guys, that after a company has indicated that it is potentially a great company, the characteristics, it's a great business, it must be simple. Again, that's debatable. It has great brand recognition, sales products or services that'll never go out of style. A consumer will purchase the product or service again and again, and it has pricing power. Now, again, what we're looking for after a company meets those characteristics, we want to see if the data backs those characteristics up. And so when we look at the rules again, and remember, we're going to be looking at Intel now. First thing we want to do is look to see earnings per share. Is there a smooth upward trend? Remember, we go here. Just do this here. Earnings per share, third column from the bottom, third row. And we see 0.53, 0.51, 2005, 2006, we see a decrease. We see an increase in 2007. We see a decrease. We see another decrease. Then we see a sporadic jump up. Then we see another decrease. So right out the gate, do we see a smooth uptrend in earnings per share? No. Again, not that it's a bad company, but right now, that's a yes or no question, and the answer to that is no. Second question. I've got to really remember going back and forth. So Intel, a smooth upward trend in earnings, the answer to that was no. a great business will show a consistent return on equity above 20%. Remember, we are looking for the 20% number. We are looking for this 20% number on return on equity. So where do we go for that? Again, we scroll down to the bottom of this value line sheet, and we are looking at return on shareholder equity. Come on. There we go. Let me just do it the other way. Return on shareholder equity. Remember, the number we're looking for is consistently above 20%. I see 16.3, 13.5, 10.5, 23, 28, 21, 16, then 18, 19. So that answer is a definite no. We don't see a consistent above 20% number. Rule 3, guys, a great business will show a consistent return on capital greater than 15%. A consistent return on capital greater than 15%. So now we're on Home Depot. No, we're on Intel. And just to show you guys where we're at again, for those of you who joined in maybe a little bit later, we're at Intel. And now we're going to see return on capital. Now remember, return on capital is right above return on shareholder equity. The number we're looking for is a consistent above 15%, consistent. That's the key phrase. It has to be consistent. So we see 15.6 in 2007, 12.9, 10, 22, 17, 13, 14, 15. So is that consistent? No. Again, it's not that Intel may not be a decent company, but right now the numbers may show us something else, where maybe we may buy Intel, but we really want to be strategic and look at the economy, look at what's going on in the technology sector before we make that investment. We may want to look at some price charts to see when to get in and when to get out. And so to answer that, that's a no. Third, invest in companies where the long-term debt could be paid off within 4 years or less. Just want to make sure you guys see this. Come on. Invest in companies where long-term debt could be paid off within 4 years or less using net profits. So invest in companies where long-term debt could be paid off within 4 years or less using net profits. So now we look at, again, long-term debt, 10 billion. Our net profits, 18.7 billion. So can we pay off that 10 billion in long-term debt in 4 years? Yes, we could actually pay it off in 1 and have roughly 8.75 left over. So that's a yes. Now remember, the first two were no, this is a yes. So we're starting to see that, again, maybe Intel is an okay company. Does it get to the point where we think it's a great company if we're looking for a long-term investments? That's debatable. Finally, a great business pays a dividend or it buys back stock. A great business pays a dividend or buys back stock. Now, remember, we're on Intel now. We're going to go to dividends. And we can see here, and value line, you want to go where you see the dividends declared per share. And the answer to that is yes. So when it comes to Intel, and Home Depot, so far the research, even though we all may know what they do, the research shows us, as far as looking at the rules and the numbers, maybe those are companies that are just like everything else. Not great, but just like everything else. Not that you shouldn't invest in them, but you may want to do more research. You may want to look at when you should invest in them, because Intel and Home Depot are those kinds of companies that sort of are cyclical. They go up and down with the economy, and so you really want to look at things like that. They react more deeply when the economy is in a recession. And just to point out, guys, on anything we're looking at, when you look at the years 2008 to 2009, if you see a decrease, a lot of times, remember that 2008, 2009 recession year. So just be leery of that when you see a potential decrease, and take into consideration that the recession hit 2008, 2009. So you will see that. So now, ExxonMobil. You know what? I don't want to do ExxonMobil. Let's do Coca-Cola. And for those of you who are still with me, just a reminder, two kinds of companies. There are great companies, great businesses, and then there's everything else. Characteristics, I just want to highlight these again so you see them. A great business must be simple, has great brand recognition, sells products or services that'll never go out of style. A consumer will purchase the product or service again and again, has pricing power, and most importantly, when you evaluate a business, that pricing power basically, to me, indicates that even if competitors entered the market, this company would still be in a position to compete. It's not just going to go out of business, or all of a sudden you don't hear from them again. The next thing you know, 10 years later, we're talking about what happened to that company, or do you remember? And so these are the characteristics of what we believe a great company will display. Now, in order to determine that, or add some validity to that, we have to look at the data. We have to look at the numbers. And so after a company has met those characteristics, we want to look at the data. We want to look at the numbers. And so those numbers will indicate to us, or give us confirmation as to whether or not this is a great company, or whether or not it's a company like everything else. So with that, remember the first rule: a great business will have earnings that show a smooth upward trend. Key phrase here: show a smooth upward trend. Let's go to Coca-Cola. Let me see if I can magnify this a little bit for you. You guys should know where to go right now. So we're looking at earnings per share, and we're looking for a smooth upward trend. Now, if you look at Coca-Cola's numbers, 0.80, 83, 98, 103, 109, 119, 129, 151. Again, remember that 2008, 2009 decrease, recession time: 175, 192, 197, 208, 204, 191. So for the most part, Coca-Cola has a smooth upward trend, for the most part. Now, later on, again, you still see the 204.2, but those decreases are not sporadic. They're not great decreases as we saw in some of the other companies. Second, a great business will show a consistent return on equity above 20%. Now remember, we're looking at above 20%. So what we're going to do, we'll go back to our value line, Coca-Cola. We find shareholder equity. And remember, the number we're looking for is 20% and up. One thing I like about Coke is their numbers. 27, 34, 27, 26, 28, 27. At no point in time is their return on equity below 20%. That's fantastic. At no point in time are they below 20%. All the other companies we've looked at we haven't seen a consistent 20. We've seen some dips here, but for the most part, that 20%, that's met. Now remember, the next question or the next rule, we're looking for return on total capital. And remember, return on total capital is right above, return on capital is right above return on shareholder equity. And the number we're looking for here is 15% and up. And if you look on total capital, 24, 30, 23, 18, 20, 19, again. So at no point in time was the return on total capital below the 15% number that we're looking for. So this is what we want to look for. We want to look for 20% and above on return on shareholder equity, and return on total capital, we want to look at 15% and above. Now, the next question or the next rule is, can we pay our long-term debt off in 4 years? Sorry about that. Can we pay our long-term debt off in 4 years with our net profit? So as you can see, our net profit, 11 billion times 4, that's 44. Long-term debt, roughly 30 billion. Yes, we can pay that 30 billion off in a 4-year time frame. Finally, we want to look for dividends declared. Are they issuing dividends? Are they declaring dividends? Are they paying dividends? And remember, we're going to go back up to the top. And as you can look, they have been paying dividends, declaring dividends. And again, usually those are in forms of stock. Some companies, some utility companies like We Energies will issue you a cash check and dividends. But yes, they are. So Coca-Cola, by comparison to, give me a second, Home Depot, Intel, is a great company. They all have the characteristics of, what we think is a great company. But when we get to the rules, when we start looking at the numbers and the data, then that becomes an issue, because now the data doesn't necessarily back up the fact that, yeah, they might be a great company. They may have brand recognition. We may know what they do, but that doesn't equate to them being a great, great company. And so the difference is not that you shouldn't invest in these companies. It just simply means to me that maybe you will look to see, is there a specific time when you should invest in that company? So you just want to make sure you can do that. And so I have on the webinar chat, you guys got questions, shoot me those questions, and I'll see if I can answer some of those, because I want to thank you all for coming. And we're going to be doing some more of these, particularly as we talk about foreign currency, other issues. But thank you all for coming, because this is actually my first webinar on this. Again, I'll make sure I upload this to the YouTube channel so you can see it. And for all of you, what I will do is try to, let me just make sure, I will email you this document. I will email you the financial promise, where to start and how to invest like Warren Buffett. So if you want that, give me a shout out, let me know, but I'll take the liberty and do that for you. I also told you guys that I would show you how to get to the value line. And so if you look on your screen, you'll see I use Value Line. Here's where you can go to find that information. Now, be mindful that unless you're a person like me, where this is you really want to research and do all this stuff, you may not have access to get the research on all the stocks you like. Um, so they do have subscriptions, and so the more information you want, the more information you're looking for, you got to pay. Now, you can go to Value Line, and you can see here, Value Line. You can type in, you can type in the ticker symbol or the company. And that information, what will come up for most of these companies is this kind of data. It's this kind of data. The reason why I like Value Line is because they tend to show a lot of information over a period of time that's consistent. So, and at some point, I'm going to do a webinar on how you read all of this, but I don't want to inundate you with stuff. I want you to just keep the simple stuff first, start playing around, investing. You know what you ought to be looking for. You have the rules, you know the characteristics. Now you have some research and data to go off on when you're looking at investing. But at some point, I'm going to do something to show you guys this. But to show you where you can go to get those reports, again, you can go to valueline.com, type in the ticker symbol or the company name here. And if you scroll down, it's a lot of information. You'll see these reports. You click on view, report here, and that report will pop up. That's one way you can find that information. Another way you can find that information is you can simply type in, if you have the ticker symbol, for example, let's say ExxonMobil, you can type in XOM and then Value Line, and you'll see it'll pop up. So that's where you can go to get that information. But for sake of argument, for the most precise and accurate information, just go to the Value Line website and then type that information up because that may be better for you. You can type in Value Line, go here, and here you are back at that information. So unless you guys got any questions, Avery, you said you can't see. What did you miss? Let me know what you couldn't see, Avery, because hopefully you can see it. And if not, again, I'll be emailing it to you. If you guys couldn't see it, let me know. There will be a recording of this. Everything about the Value Line website. So let me show you again, Avery, where you can go for that. So you can just type in Value Line, and this will pop up. Hold on, Avery. Let me just make sure you can see it, Avery. All right. So you go to Value Line, Avery, and hopefully you can see it now, but you can type in valueline.com. And again, if you want it, what you should do is, if there's a company that you want to do research on, let's say we did Intel, we did Coca-Cola, let's say Sprint, just because off the top of my head, that's what came up. Sprint stock is at $5.29. Their 5-day chart here, wow, took a little bit of a hit. And as I was saying, Avery, now here you see when we go to Sprint, remember on the other ones, we saw those reports. For whatever reason, they don't have those reports on Sprint. And so Sprint may be a company that they follow only, they don't follow in great detail. But they usually follow the major stocks, the Dow, things of that nature. Intel, you can see Coca-Cola. Let me think of another. I think AT&T is AT&T. Let's see if they follow AT&T. Nope. So some of these companies, you won't see that data, Avery. But to give you just, I'm looking at AT&T. AT&T stock is at $37.44. I'm going to do a webinar and walk you guys through some of this stuff on the value line. So let me know, Avery, if you got a chance to see it at that point in time. But remember to go to the website. Hopefully I didn't keep you guys too long. Remember, I'm going to upload this as a YouTube channel. I'm going to make sure you all have that sheet so you don't forget that, hey, this is the process that you can go through in order to get that information. So, oh, good, Avery. I'm glad you can see it. So unless you guys got any other questions for me, remember to continue to follow the website. And do me a favor, man. If this was helpful to you all, let me know. Shoot me a shout out. Shoot me something and say, hey, this is what you could have did better. One of the ways I get better at my craft is by receiving and asking for honest criticism. So I want to make sure you guys let me know, yo, Jay, great, but do this next time, try this next time, because this is not just about me, man. This is about all of us making this money. And if you guys like this kind of stuff, I'm going to do some stuff on cryptocurrency. And then I'm going to show you some of the stuff that I look at when I'm debating and deciding on where I want to get in at. And so I'm going to do some of that stuff on foreign currency. The foreign currency stuff y'all might like, because, you know, a lot of this stuff is not complicated, but you just need somebody to be like, okay, let me break it down and let me show you, and then you can roll with it. So unless y'all got any other questions, man, if this was good for you all, do me a favor, give me a mad shout out on Facebook, LinkedIn, Twitter. Let people know, yo, your boy is just trying to give y'all some knowledge. So thank you all for joining me. Love y'all, man. And continue to follow the website, sign up for the classes, and we're going to be looking to do some more webinars. And if y'all got suggestions on things you would like me to try to cover, shoot me an email, shoot me a text. I ain't hard to get a hold of. So if y'all got any other questions, man, if not, I'll see y'all at my next webinar, yo. That one will be free as well. But make sure you enroll and take some of the classes, because at those classes, we're able to get in some things that I can't do on the webinar. So love y'all and peace, man. Had a good time. I'm out.